It is all about inflation, baby. This is Pounds for Breakfast coming up right now. Okay, good morning, you beautiful humans, guys. It is Tuesday. You know the drill. It is CPI day right now. What is CPI? How are we going to trade it? What is it all about? I'm about to break it down in the next couple minutes. I'm going to keep it short. I'm going to keep it sweet. I'm going to keep it quick. But ultimately, what you need to know is the data we're about to get today, this afternoon, is some of the most important data for this month, for traders, for markets, for Wall Street, for commodities across the world. The data we're about to see today has a ripple effect around the markets and around the world, right? There's never been a better time, not only to be a trader, but to understand what is happening in the world of finance, in the world of markets. And that is why I highly encourage you, if you've thought about getting into trading, you've tried it, you haven't been serious about it, now is the time, right? Down in the link down below is my Quantum Growth Markets Academy course. It's free. It's right here, available on YouTube. There's 8 episodes. It's 8 hours of me teaching you from the history and start of how money was made all the way to where we are now, advanced analysis, fundamentals, and so much more. So if you want to get started, you know this is your time, then hit the link down below. Get started. It's absolutely free and available to you to take advantage. But we're here, we're now. What are we going to do about it, right? So CPI, let's jump into it. Let's break it down. What does this mean for us as traders? What could we potentially see, and how are we going to deal with this today? Before we get into it, guys, if you're part of Premium Plus, yesterday we absolutely smashed it. New York Stock Exchange was a little bit of a sideways market, and we decided rather not to call out and take a signal there. But other than that, for a Monday, we started off strong with a very powerful gold buy. We took some NAS long positions, buys on NAS, which were also great. We also took a short on the reversal of gold. So starting out Monday, we banked just shy of 200 pips on those trades already. And that's all in preparation for what we're about to see today as well as tomorrow. Now, if you want to be part of Premium Plus, there's a monthly charge. If you have a live account with our partner brokers, that is discounted by 50%. If you don't, it's a straight 999 Rand for a month's access. And that gives you all the trading signals that I take throughout the day, and we're absolutely smashing it. There's nowhere else on planet Earth that this is happening right now other than right here at DVDM Market. So if you want more info, down the link below, smash the link, drop us a comment, and we'll get you started, get you into Premium Plus. The most important part is open up your live account, get it funded, send us proof of the funding. That's going to be the very first step. So without further ado, let's jump in and let's have a look at what data we have today. So CPI is coming out today, and whoever arranged this economic calendar deserves to be shot, right? I wish they could just list, core CPI year on year with core CPI month on month, and then CPI year on year with just CPI month on month, right? They end up putting these things staggered away from each other when they just really need to be right next to each other. So what is core CPI? What is CPI, right? First and foremost, you need to understand is CPI, Consumer Price Index, or otherwise known as Consumer Price Inflation, right? Ultimately measures what the level of inflation is on the consumer and spending side of things, right? Now, looking at where we are, if we just rewind a little bit, if this is your first time trading with us or first time dealing with CPI or any of these fundamental data events, please drop it in the comments. I would love to hear from you. I will reply to all comments in this video. If this is your first time, just let us know. Ultimately, if we have a look at the pandemic pretty much put the world into shock, put the world into lockdown. And what happens, right? Governments start just printing money, creating all these sustainability incentive programs. Ultimately, they just print a bunch of money and stimulate the economy, right? This is what we call quantitative easing, right? A bunch of money is printed, chucked into the economy. Governments start actively participating in the economy, buying bonds, buying yields, buying all these different mechanisms, right? Creating this bunch of debt, basically to prop up the economy for that missing economic activity. Because remember, people are sitting at home, people are not working. The economy isn't doing what it's supposed to be doing. So a pandemic happens, economies and governments around the world start injecting and just printing money. You understand what that's about, go into my Quantum Growth Markets Academy and understand the history of money, and then you understand why we can just print money, right? Why it's just a piece of paper that, people decide what the value is. There's no real underlying value. But anyway, more on that in the academy down below. But that ended up happening, right? Now, what happens is that when they overstimulate an economy, right, what ends up happening is that the dollar, the rand, the pound ends up buying less and less, because you're essentially injecting a bunch of money into a system. And if you've got $100 only in an economy, those $100 have got huge amounts of purchasing power. But if you take $100 and make it $1 million in an economy, that purchasing power starts to diminish. And you go ahead and Google, the value or the impact of inflation to the dollar, and you'll see that over the last couple hundred years, the dollar's become substantially weaker, representing a fraction of what it once was in terms of its purchasing power. Now, this is what we call inflation, right? Where essentially the dollar is able to buy and have the purchasing power less and less. Hyperinflation is what all economies struggle and fight to try and avoid. An example of hyperinflation would be what happened in Zim, right? Zim had the Zim dollar. You were purchasing a loaf of bread for a couple Zim dollar, then 100 Zim dollar, then 1,000, then 100,000, then 1,000,000, then 1,000,000,000, then people just bringing, sealed blocks of money to a bar just to buy a beer, as an example. That's an example of hyperinflation, and that's what every government, that's what a Federal Reserve, that's what the central bank's goal is, and essentially their function is price stability. So when we talk about the US Federal Reserve, their goal is price stability. That's all, right? That's all. That's their mandate, is price stability. There's a couple other things, but the biggest goal on their list is price stability. So how do they keep price stable, right? The pandemic happened, lockdown happened, people stopped working, they injected and printed a bunch of money into the economy, and now this economy is red hot, it's glowing. It's a bunch of new monies in the system, got a bunch of people kind of unemployed, but also employed at the same time. How do they keep this under control? Well, there's two mechanisms, right? At the point at which they're trying to stimulate the economy, what they do is they drop interest rates. Outside of injecting money, they drop interest rates, meaning they make acquiring credit extremely cheap. So they drop interest rates to almost zero, to the point where if you go ahead and lend money, it costs you basically nothing in order to lend and repay that money back. So when difficult economic times happen, interest rates are dropped, cheap and easy credit becomes available, everybody lends a bunch of money, right? This is great. It stimulates people, purchase things, people go on holiday, people buy cars, houses, whatever the case may be, even though the economy is sitting in a pretty bad position. Now, on the other side of that, once the economy starts to show signs of recovery, they need to cool down this economy, right? And they look at inflation as where they need to get it. Now, example in the US, their goal is to get base inflation back to 2%, right? So we'll go over the data just now in a second. We'll see where it's at and where they need to get to. But how do they do that? They do that by raising interest rates again. So meaning acquiring cheap money becomes a little bit more expensive, right? It does two things. It incentivizes, when interest rates are high, it incentivizes external investors to come invest into the US economy. Why? Because government bonds, some yield, some base interest rate items are attractive. So if you look at the world as a destination and you see that US is raising interest rates, you go, that's a good place to put my money. A, it's safe because it's the dollar's the world reserve currency, but B, I'm going to get a yield, I'm going to get a dividend, I'm going to get interest on my money, right? Previously, interest rates in the US were extremely, extremely low. Now interest rates are higher. So it incentivizes people to come and invest. However, it disincentivizes people to go and create credit or create debt, right? Because they're going to end up paying more for that debt. So raising interest rates squeezes and tightens the US economy. Now, the Federal Reserve has been on a rampage. If you've been with us in previous broadcasts, we've been covering what the interest rate announcement is, what it does, and what the effect has been on the markets. Traditionally, what we've seen is when the US raises interest rates, the dollar benefits, but the stock market does not, right? So US 30, NASDAQ, these markets all have a big knock-on effect and to have a negative knock-on effect when interest rates are risen. Now, where we are right now, and the reason why this is such an important place to be, is if we have a look at the data, we're starting to see interest rates start to come down, right? We're seeing negative forecasts, meaning that if we had a previous CPI, right, year on year, right, that means the inflation from last year to where we are right now, 12 months ahead of time, right? Previously, for April, it was sitting at 4.9. For May, they're expecting that number to come in at 4.1, showing that inflation is coming down. Now, what does this mean, right? These forecasts are presented by analysts. And again, these numbers can be all over the place. But what our job is as traders is to have a look at these numbers. This is what the market is pricing in. The market is pricing in For CPI year on year, it's going to come down to 4.1%. For CPI month on month, they're expecting a month on month growth of only 0.2% in a raise in inflation, coming off a 0.4. So it's showing that slowdown in inflation. Now, our job as traders is to do two things, is to look at these numbers and have a look at, does markets price this in? Is this what the markets believe to be true? And if so, when we get the numbers, what is the deviation from this number? Because if markets are pricing in a 4.1, means if we achieve a 4.1, markets are happy, normal price action, normal business as usual. But if we get a 4.5 or 4.6, it shows that inflation is coming down, yes, but not as much as the market would like to have seen. And this might be cause and reason for tomorrow, the federal interest rate announcement with Fed Powell. That announcement can all pivot based on this information. Okay, so example, I'll paint two pictures for you, right? Before I paint those two pictures, I just want to break down what is the difference between CPI and core CPI, right? You'll see we have a core CPI year on year, right? Then we have a core CPI month on month. So core and normal CPI. All that core is core takes normal consumer price index, consumer price inflation, and removes the most volatile items from that. The most volatile items are going to be food and energy, right? So if you guys know all the political tensions around the world with regards to, oil reductions, with regards to Russia, Ukraine, all these other issues, it places a big strain on energy. And this will be gas, oil, all these other items that contribute towards energy. Other item that has a big ripple effect on inflation is food. So when they read the core CPI numbers, this removes food and energy, the two most volatile numbers. And that is what economists believe is the most true item. However, you can't ignore food and energy, right? Because that's exactly what happened in Zim, right? Food and energy were the two that went rampant and everything else ended up following. So core CPI just looks at CPI and ignores food and inflation, where CPI takes it into account. So it's important for us to see, is one growing or slowing down quicker than the other? I just wanted to point that out really quickly. But in terms of this afternoon, what does this mean, right? Two things. I have a very good idea of what I'm thinking, where things will go, and I'm going to share this with my Premium Plus subscribers this afternoon. But ultimately, there's two things that could end up happening here. First thing, as always, we could get a mixed bag, right? Where we see core CPI come in lower than expected, right? Lower than expected number means bad for the dollar, great for the stock markets. Stock markets are going to say, hey, Powell's going to take it easy on us, and stock markets are going to rally. We saw a little bit of a hint of that based on yesterday's trading, that markets responded positively after the New York Stock Exchange opened. So either the markets know something we don't, or there's a little bit of a trick at hand here, where we're seeing markets rally, creating this positivity, and the numbers could come opposite. Opposite being that we see numbers lower than expectation, meaning, higher than expectation, apologies. So if we see numbers higher than expectation, so let's have a look and pay attention to, so you see this core CPI over here. Let's say, there's this forecast for year on year to come out at 5.3, right? What happens if it comes out at 5.5 or above, right? Higher than expected. This will mean the US economy is much more stimulated than what it needs to be. This will be good for the dollar, and this will be bad for US 30, US 100, S&P 500. Because why? This means that Powell is more likely to raise interest rates tomorrow evening. And remember, we are going to cover that live if you do have a Premium Plus account. So there's these eventualities. Now, I will be breaking this down for Premium Plus subscribers this afternoon prior to the data coming out, as well as I'll be giving out my trades on what I'm trading before this even happens. Now, my goal for today is a couple things, right? First thing is that I would like to be in profit before the CPI even happens, right? So again, if you're part of Premium Plus, my goal is going to be for us to be in profit in the position that I think is going to end up materializing this afternoon, so that we can have our stop losses in profit, trades running in profit, risk-free. So if markets pop off, they pop off without us having to put any additional risk in. That's the first thing. The second thing being, if that isn't possible, or markets start to change, or go a little bit sideways before the data, because we do see that markets tend to slow down, pause prior to the data, I will then be sending out my position live this afternoon. Now, the only difference with this afternoon and all other previous ones is I generally go live and we talk about it, we break it down, we see the number release, and then we trade. However, this afternoon, I'm going to do it a little bit differently. in the sense that I'm going to be focusing on the charts. I'm going to be focusing on all the charts. I'm going to be focusing on sending out the best quality trades that I can produce. And I'm not going to be live for that because I want to focus on the markets. I want to focus on having all my charts up and available. I want to focus on the groups. I want to focus on the chats. So if you're part of Premium Plus, you're in for a treat because we're going to be taking things to the next level this afternoon. Okay, so you definitely want to be a part of that. If you want to be a part of Premium Plus, super simple. If you're a part of Premium Plus yesterday, as an example, just in yesterday's profitable trades, you would have paid your subscription for the whole month, done and dusted. Even on the smallest lot size you can take on gold, you would have paid off your subscription for the month, right? So definitely worthwhile jumping in and being a part of that. Let's have a look at what happens this afternoon. Today's data will set the tone for tomorrow. And remember, we have PPI tomorrow, not as big of an influence as CPI, but Producers Price Index or Producers Price Inflation plays a role. And then remember, Wednesday evening, we have Powell's announcement that I will be covering live, that we will be listening into, we'll be looking at the outcomes just as we do every other day with regards to fundamentals. So guys, as always, if you're part of Premium Plus, massive thank you. If you're not yet part of Premium Plus or you're just getting started, link down below, start your Quantum Growth Markets Academy. Start from video 1. You'll see it's in part 1 to part 8. Go through the series. Once you feel ready, open up, get your account funded, and then jump into Premium Plus so that you can start making money while you're still learning. Remember, financial markets are extremely risky. Nothing that I do should be taken as financial advice. This is education, and to see the community grow and bring back prestige to what isn't been known to be a trader. Other than that, guys, listen, appreciate you all. As always, be safe, trade safe. I'll see you guys all a little bit later. And until then, as always, much love. Goodbye.